Good morning. Welcome to your daily Solo 401k webinar and Q&A session with my Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. So today's topic is, how many Solo 401ks can I have? We get this question all the time from self-employed business owners. It sounds simple, but the answer is surprisingly nuanced. And knowing the right answer can save you major headaches and avoid IRS issues. So this is your chance to get answers. Use the chat to ask questions on today's topic or anything else. Chat them over now so that we can be sure to get to them all. Let's get started. So the big question, can you have more than one solo 401k? So the answer really depends on how your businesses are structured. And understanding these rules will prevent IRS rules, or issues, I should say. So, key concept, control group rule. Before we start talking about these regulations here, let's first understand the solo 401k eligibility requirements. So to open a solo 401k plan, you must be self-employed with no non-owner, non-spouse, full-time W-2 employees. This means you can have part-time employees in your business. So those working under 1,000 hours. You can also employ contractors, so independent contractors, but you cannot employ any full-time W-2 employees who are not owners. So if someone is a W-2 employee, is not an owner in your business, or is not your spouse, and that individual works 1,000 hours or more, then you would not qualify to open a solo 401k plan. And you generally have to apply that rule across all of your self-employed businesses. You can also exclude union employees from participating in the solo 401k plan, as well as those who are under age 21. So even if you employ someone who's a W-2 employee who works 1,000 hours or more, as long as they are under age 21, they can be excluded from the solo 401k plan, and therefore you would qualify to open a solo 401k plan. So those are the eligibility requirements. Now, with respect as to whether or not you can have more than one solo 401k plan, it's going to come down to the control group regulations. The control group regulations deal with related businesses under your control. In other words, businesses that you own. So if you own multiple businesses, and let's say you are the only owner in those businesses, then it's just one plan. So you would open up just one solo 401k plan, and that plan would be sponsored by at least one of those businesses. And then on the actual plan documents, there's a box that would be checked off titled control group or affiliated service group, which means that you are the owner of all of those businesses. You're the sole owner. And as a result, you would be able to contribute to the one solo 401k plan based on your aggregate net self-employment income from both of your businesses that you own. So that means that If you own all those businesses, and that means that, again, it's just one solo 401k plan. You would not open up a separate solo 401k for each self-employed business if you are the sole owner of those businesses. So just one solo 401k plan is required to cover all of your net self-employment income from all of your owner-only businesses, which means that the contribution limits apply across all of your companies combined. So if you own multiple self-employed businesses, you're not going to be able to double up on contributions. You cannot double up on 401k participant loans. You're required to file Form 5500 easy in aggregate, meaning you have to aggregate the balance of that entire plan to determine whether or not the fair market value of that plan exceeds $250,000 as of the end of the plan year. Because once the market value of that solo 401k plan exceeds $250,000 as of the end of the plan year, then a Form 5500 easy is required to be filed. So for example, if your plan year end is December 31st and the market value of that solo 401k plan is greater than 250,000, a Form 5500 easy would need to be filed by the following July 31st. So regarding one solo 401k plan for your multiple self-employed businesses. Now, many of our clients like to have both a brokerage account and a bank account for their solo 401k plan. So that doesn't mean you're opening up multiple solo 401k plans. In other words, you can have multiple holding accounts for the same solo 401k plan. Holding accounts translates to bank and brokerage accounts in the name of the solo 401k plan. So for example, you may want to have a bank account in the name of the solo 401k plan at your local bank because you want to invest in cryptocurrencies. Because when you invest that solo 401k in cryptocurrencies, you're going to need to have a separate bank account in the name of the solo 401k plan, also using the solo 401k employer identification number when opening that bank account. And then at the exchange, let's say you use Coinbase or Gemini or Kraken for the cryptocurrency account. You would also open up that cryptocurrency account at Coinbase, Kraken, or Gemini in the name of the solo 401k plan. And then you would link that cryptocurrency exchange account to the solo 401k bank account so that the funds are invested from the solo 401k bank account directly into that cryptocurrency account. So that's one example of having to have a bank account for the solo 401k. Now, another example of having multiple holding accounts, aka bank and brokerage accounts under the same solo 401k plan, is if you want to invest in equities, that is stocks, index funds, exchange traded funds, and so forth. So you would also open up a brokerage account at Fidelity or Schwab for that same solo 401k under the solo 401k plan. So you would not open an actual solo 401k plan at Schwab or Fidelity, but instead what they refer to as business non-prototype brokerage accounts, which means that those are brokerage accounts provided by Fidelity and Schwab for a solo 401k plan offered by an outside solo 401k provider, such as my solo 401k financial. So now you would end up with having a bank account in your local bank for investing in cryptocurrency through the solo 401k, which is titled in the name of the solo 401k, and then a brokerage account at Fidelity or Schwab, for example, for that same solo 401k, so that you can invest in equities. Now, when you open a solo 401k with a company like my solo 401k financial, that's typically referred to as a self-directed solo 401k plan, meaning it allows for not only investing in equities, such as stocks and index funds, but also alternative investments, whether it's cryptocurrency, physical real estate like commercial, residential properties like rental properties, secured promissory notes, aka trust deeds, tax liens, even precious metals. I know gold just hit an all-time high today of over 4,000. So gold is a very popular investment right now. And when you utilize my solo 401k financial, you can make all those types of investments. Now with this, so again, this is an example of having just one solo 401k plan, but multiple holding accounts, aka bank or brokerage accounts, where you have a bank account at the local bank in the name of the solo 401k, a brokerage account over at Fidelity or Schwab for the same solo 401k. So same plan documents. Those are the plan documents provided by the solo 401k provider. So here's an example scenario of just one solo 401k plan. A client has two businesses, one consulting and one rental real estate business. Because both businesses are owned by the same individual and they don't employ any full-time W-2 employees who are non-owners in both of those businesses, you're able to open a solo 401k plan, which is sponsored by just one business. In this case, it would be sponsored by the consulting business, but you're still going to be able to contribute to that solo 401k plan based on not only your self-employment income from your consulting business, but also from your real estate business, because they're both owned by you. So now you just have one solo 401k plan. So it's now multiple solo 401k plans. When can you have more than one solo 401k plan? Well, if your businesses are completely unrelated, what the heck does that mean? Well, specifically, that means that you are not the owner, you are not a 50% or more owner in the second business. And also, that second business, the other owner of that second business is not your spouse, for example, but it's an unrelated party. And as a result, you could have two solo 401k plans. One for your first self-employed business where it's just you, and then a second solo 401k plan for the second business where you are not a 50% or more owner in that business, and the other owner or owners is now your spouse or your children. So that means that when you have two separate solo 401k plans for each of those businesses, you're going to be able to make contributions to both plans. For example, you could make employee contributions to the first plan up to the maximum allowed limit, which is $23,500 for tax year 2025, for example. And then for the second business, where you are not a 50% or more owner, you could contribute employer profit sharing contributions to that plan, even if you also made employer contributions to your first solo 401k plan, because employer profit sharing contributions are not subject to the aggregation contribution rules. You could also make voluntary after-tax solo 401k contributions as part of the Mega Backdoor Roth solo 401k strategy to both plans if you wanted to. So for example, business one, let's say business one is let's say you're an attorney and you open a solo 401k plan for your first business where it's just you. It doesn't employ any full-time W-2 employees. You're the sole owner of that business. You could do a Mega Backdoor Roth solo 401k strategy in that law firm business where for 2025, if you have enough net self-employment income from that particular business, you could contribute $70,000, which is the overall limit for tax year 2025, as a voluntary after-tax solo 401k contribution, and then turn around and convert that contribution to the Roth Solo 401k plan. So you would make it to this bucket right here, the voluntary after-tax Solo 401k bucket, also known as a bank or brokerage account, and the name of the plan. And then you would contribute that directly to the Roth Solo 401k plan. Now, let's say that your second business, where you are not a 50% or more owner of, let's say you open a solo 401k plan for that second business. Let's say the other owner is not related to you. So let's say the other owner owns 51% of the business, and therefore you own 49% of the business. So you can open up a solo 401k plan for that second business. Now, let's say that second business is a real estate operating company where you and that other business owner manage real estate that's not owned by the solo 401k plan, but real estate that's owned by that business. Let's say it owns multiple rental properties. You're doing the actual work where you're screening tenants. Maybe you're doing some actual physical work as well, such as fixing a leaky toilet, painting the house. But you could just be doing managerial services where you're doing the actual work, managing the books, things of that nature. Well, if you open a solo 401k for that business, as long as that business does not do business with your law firm business, so your other self-employed business, so you get those businesses have to be completely separate. You got to put a wall between those businesses. If you could open a solo 401k for that second business, and you could actually make employer profit sharing contributions to that second business's solo 401k plan based on your earned income from self-employment activity from that second business. Even if you maximize your employer contributions to your first solo 401k plan, where it's just you. So here, you could also make voluntary after-tax solo 401k contributions. You would not be able to make employee contributions if you've already maximized your employee contributions to that first solo 401k plan. But you could make employer contributions as well as voluntary after-tax solo 401k contributions. If you want to maximize your employer contributions and voluntary after-tax solo 401k contributions to that second plan, the overall limit would be $70,000 for tax year 2025. So you would need to pay yourself enough net self-employment income from that second business so that you could maximize contributions, that is profit sharing and voluntary after-tax contributions to that second plan. You could also choose to solely make voluntary after-tax solo 401k contributions to that second plan as part of the Mega Backdoor Roth Solo 401k strategy, even if you maximize your contributions to the first solo 401k plan for the other business where it's just you. So for that second business, if you pay yourself at least $70,000 of earned income from self-employment activity, assuming that that second business is taxed as an S corporation, then you could contribute the entire $70,000 to that voluntary after-tax solo 401k bucket and then convert it to the Roth Solo 401k. Now, that second business where it's just you and that other owner who owns 51% or more and you own 49% or less, and those businesses don't do business with each other, the other owner in that business can contribute to that second solo 401k plan if he or she wants to, but he or she is not required to do so. So this example here would be is an example of a two-participant plan. Let's say two owners in the business. So business owner one being you, who owns 49% of that business. The other owner owns 51% of that business, who's now your spouse. They're not related to you, but rather they're a separate owner. So that other individual would have three separate holding accounts under the plan. You would also have three separate holding accounts under the plan to hold your respective fund sources for each participant. So it's still one plan. Now, that other owner is not required to contribute to that plan, and you're still going to be able to make contributions to that second solo 401k plan. So that's an example of an instance where you can have multiple solo 401k plans. We have a handful of clients that fall under that scenario. Not very many people do because you have to follow those specific regulations. Okay, so if this information is helping you feel more confident about your future, please take 1 second to like and subscribe. It tells the platform this content is valuable, which helps other solopreneurs like you find it. Subscribing guarantees you get notification of all of our crucial content that we deliver every day to help you secure your retirement. Visit our YouTube channel with over 900 videos for topics like this. We've actually covered the topic regarding contributing to both your daytime employer to both a daytime employer 401k as well as a solo 401k, which is a different concept than what we're talking about here. But that's just an example of how in depth we go into solo 401k topics that not everybody covers, because we have a lot of knowledge and a lot of experience in this industry, having opened up thousands of accounts since 2009 when we first started. You can also visit our community where you can post forums. If you're a financial professional, you can even post a guest blog post or posts, and you can even link it back to your company website. And the 30,000 plus members of our community may be interested in your services. So whether you're a CPA, accountant, attorney, real estate agent, broker, insurance agent, any type of professional, you can post guest blog posts on the community, link it back to your company so that the 30,000 plus members can view what services you offer. And heck, they might even be interested in some of those services. Okay, let's continue. So today's topic is how many solo 401ks can I have? We've been talking in great length regarding that topic. Looks like we have some questions here. We'll get to those questions in a moment. Let's keep going over some items here. So we've already covered all these bullet points here. We talked about how you can have multiple holding accounts under one solo 401k plan. We already went over this real example scenario. We talked about when you can have more than one solo 401k plan. We talked about if your businesses are completely unrelated, you may establish solo 401k plans, a separate solo 401k plans. Each plan can have its own contribution limit. The IRS looks at the ownership, control, and business relationships. So we were just talking about how you need to make sure that you own less than 50% of that business, that second business, and that second business does not do business with your first business in order to have separate solo 401k plans for multiple businesses. So we already covered that. We'll talk about these common mistakes in a moment here, but for now, let's take a look at some questions here. Okay, we've got a question here from Matt. When working with my solo 401k financial and using Schwab as a custodian, which Schwab account type is used? Is it a Schwab I401k, a PCR SDBA, or another account type? Great question. So keep in mind that Schwab also offers their own solo 401k. They refer to it oftentimes as an I401k, which means individual 401k. It's still considered an owner-only solo 401k. So a self-employed solo 401k or self-employed 401k can be referenced by various names, but they all mean an owner-only plan, which means it's for owner-only businesses. So when you're looking to open a brokerage account at Schwab for a solo 401k offered by a company like my solo 401k financial, that's referred to as a company-only investment retirement account. Here at my solo 401k financial, we'll actually draft those Schwab company retirement account brokerage accounts for our clients. we have a lot of advisor clients, institutional advisor clients. As a matter of fact, the majority of our business is institutional based, not retail based. Institutional based means that advisors use my solo 401k for their solo 401k clients, and we'll actually prepare those institutional Schwab brokerage account forms, aka company retirement brokerage accounts, for the advisors so that they're pre-filled out, and all the advisor needs to do is just input the client's pertinent information, such as their date of birth, social security number, and so forth, and then they can submit those Schwab, those brokerage accounts to Schwab through their back channel. Again, we do have retail clients as well. We'll also prepare those company retirement brokerage accounts for Schwab as well. We'll even fax them into Schwab for you so that you don't even have to leave your home to open up those brokerage accounts. So here in my solo 401k financial, we'll take care of not only setting up the plan, also obtaining the employer identification number for the solo 401k plan. Keep in mind the plan requires its own separate EIN number because it's a retirement trust. You cannot use the EIN number for the business. And a lot of times, a lot of our institutional clients, so the advisor clients, their client may already have a Schwab I-401k, aka solo 401k, and they restate that solo 401k plan to a plan for my solo 401k financial because they want to be able to get the auto contribution credit, which we'll cover in a little bit, added to that plan. They'll also be able to take solo 401k participant loans. They'll be able to utilize the Make It Back to Roth strategy. They'll be able to invest in alternative investments like cryptocurrency, real estate, private equity, as well as equities like stocks and index funds, for example. But to answer your question again, Schwab refers to brokerage accounts for a self-directed solo 401k offer by an outside provider like my solo 401k financial as a company retirement account application. Now we can do the same thing at Fidelity on the retail side or the institutional side. And Fidelity refers to those brokerage account forms as non-prototype brokerage accounts and also investment only brokerage accounts. And we'll also shepherd our clients through opening up those brokerage accounts at Fidelity for the solo 401k that we offer, whether it's at the institutional side or the retail side. So good question. Let's see here. Got a question here from Matt. A business owner is part of an affiliated service group and has an individual 401k at Schwab. He has recently been informed that the plan document at Schwab is not complying with ASG regulations as it cannot exclude the business owners. Can this business owner adopt a new plan document with my solo 401k and keep his existing Schwab I 401k? No, he would not be able to keep his existing Schwab individual 401k. He would have to restate that Schwab individual 401k to a solo 401k plan offered by my solo 401k financial. And then we would help that client open up institutional brokerage accounts at Schwab. So we would prepare, as I mentioned earlier, what Schwab refers to as company only investment brokerage account forms. And then that existing solo 401k at Schwab would get transferred in kind to the new brokerage accounts for the solo 401k offered by my solo 401k financial. That means that the individual would not have to liquidate his existing equity positions. Those can be transferred in kind to the new brokerage accounts for the solo 401k plan offered by my solo 401k financial. As a result, the funds would never leave Schwab. The reason you cannot continue to use Schwab's individual 401k is because the new brokerage accounts is for the plan offered by my solo 401k financial. Schwab's not going to allow you to just substitute my solo 401k financials plan documents with Schwab's documents. You're going to have to open up separate brokerage accounts. In this case, on the institutional side, if you're the advisor in the account for the solo 401k plan offered by my solo 401k financial, that's referred to as a restatement in the eyes of the law. And when you restate an existing solo 401k plan to another solo 401k plan, that's neither taxable nor reportable. In other words, Schwab is not going to generate a Form 1099-R, nor do you have to file final Form 5500 easy because you're not closing the plan. Instead, you're changing providers. You're changing from Schwab as the solo 401k plan document provider to my solo 401k financial as a plan document provider. We actually have a great website on our great page on our website that covers these rules. Let me see if I can find that here for you, and I'll share that with you. Give me a moment here. Give me a moment. I'll dig that up here. Wow. And you can search our website on the top right corner. You can type in keywords and hit enter. You can find information regarding several topics, or various topics, I should say, regarding the solo 401k. Let me send you a link that's specific to your situation. So take a look at that link I just shared with you here. There it is there. That's going to be very helpful for you. Okay, let's continue with our topic today. And we'll come back and take a look at any other questions we have here. In the meantime, go ahead and continue to type over your questions and we'll get to them as we proceed with today's topic, which is how many solo 401k plans can I have? Okay, go ahead and type over your questions and we'll get to them as we continue with today's topic. So, common mistakes to avoid. Setting up multiple solo 401k plans for related businesses. And we talked about related businesses earlier. A related business is where you are self-employed, you're the only owner in the business, but you own multiple businesses where you're the only one who's self-employed in that business. So they're both owner-only businesses. So again, you cannot double up on contributions when you own multiple businesses where you're the sole owner. You have to aggregate your contributions based on all of your net self-employment income activity, which under limited circumstances, you may end up not being able to contribute if you have positive earned self-employment income from one business, but you have negative net self-employment income from the other business. You may not be able to contribute for that year because when added together, combined together with your self-employment income from both businesses, you may end up having negative net self-employment income from one business. So it's important to aggregate your self-employment income from both of your businesses under your control or multiple businesses. Likewise, maybe you have positive net self-employment income from both businesses. Therefore, you can aggregate the net self-employment income from both so that you can contribute. That doesn't mean you can contribute $70,000 twice. So for 2025, the overall contribution limit is $70,000. You can't contribute more than $70,000 for someone who's under age 50. Of course, you've got other contribution amounts you can make, such as the catch-up contribution of $7,500, or even the super catch-up contribution of $11,250 for those who are age 60, 61, 62, or 63 in tax year 2025. And again, if you go to our YouTube channel and subscribe to it, we have hundreds of videos, over 900 videos that we've put together on all these various topics, including the contribution limits. And remember, just because you have multiple self-employed businesses, it's only one solo 401k plan. So you have to aggregate all of your net self-employment income when making contributions, and you have to aggregate the total value of that solo 401k plan to determine if you file a Form 5500 easy. So you need to make sure that you maintain just one solo 401k plan document. So again, you can have multiple holding accounts for the same solo 401k plan. We already talked about this. That means you can have a bank account and a brokerage account for the same solo 401k plan, but it's still considered one plan, one master plan document. So it doesn't mean you have multiple plan documents. It's one plan, same EIN number. It's actually a red flag if you have multiple solo 401k plans with separate providers. Let's say you have a solo 401k at Fidelity using Fidelity's plan documents, aka Fidelity Solo 401k, but then you also open up a solo 401k with my solo 401k financial. Now you have two separate plans for the same business. Now, that's going to put you on the IRS radar because the IRS is concerned that individuals think that by having separate solo 401k plans for that same business, individuals can double up on contributions, they can double up on participant loans, they can skirt having to file a Form 5500 easy, which applies once the market value of all the balances in your solo 401k plans are greater than 250,000. So let's say you make a mistake and you have two solo 401k plans, one at Fidelity and one with my solo 401k financial. You're going to want to close that Fidelity solo 401k ASAP by restating it over to the solo 401k from my solo 401k financial. If you don't, and the combined balance of both of those plans is greater than $250,000 in value, you're going to have to file two separate Form 5500 EZs, one for each plan, and now you're going to get on the IRS radar. And again, it's going to cause concern with the government because they're going to think you're trying to double up on contributions, you're trying to double up on taking 401k participant loans, and worst of all, you're trying to avoid having to file a Form 5500 EZ. And if you fail to file a Form 5500 easy, the government charges $250 per day for each day that 5500 easy is now filed. So that can quickly add up to tens of thousands of dollars in IRS penalties. So I can't stress enough why it's a bad idea to have multiple solo 401k plans if you're self-employed in the same businesses, or if you own multiple businesses where it's just you, it's just one plan. It's not separate plans. Okay, let's continue here. We already talked about this slide here, having separate bank accounts and separate brokerage accounts under one plan. That doesn't mean you have multiple solo 401k plans. That means that you just have one plan. So again, clients of my solo 401k financial would fall under our plan document. They would be able to open up bank accounts and brokerage accounts if they want for the same solo 401k plan. It's not considered separate plans. So it's considered one plan with multiple holding accounts at different financial institutions. That is a bank and a brokerage firm in this example here. Okay. So we've already talked about the IRS control group regulations. We talked about how to consolidate accounts properly. In other words, if you decide that you want to restate your existing solo 401k, let's say at Fidelity, Schwab, or even T. Rowe Price or as Census, that would be considered a restatement where you switch from those institutions, so Fidelity, Schwab, or a Census, to a solo 401k from my solo 401k financial. It's known as a restatement. It's not going to trigger filing a Form 5500 easy or Form 1099R because you're not closing the plan, you're changing providers. So make sure you don't file a final 5500 easy when you restate that plan. That's going to cause confusion with the government, and it may subject your plan to the 12-month cooling off period, which means you would have to wait 12 months before you can open up another solo 401k plan. We talked about managing contributions across multiple income streams. This deals with if you are self-employed in separate self-employed businesses where you're the only owner. We talked about how you have to aggregate the self-employment income from all of your self-employment activity when contributing to just the one solo 401k plan. Compliance steps to keeping your solo 401k in good standing. Well, we touched on this already. Make sure you don't open up multiple solo 401k plans for the same self-employed business. You can have multiple holding accounts. Don't confuse that regulation. Multiple holding accounts for the same plan, that aka a bank and brokerage accounts, where you're using the same plan document. That doesn't mean you can have another solo 401k at Fidelity and one with a solo 401k with separate plan documents. So keep that in mind. Okay, let's look at some more questions here. Matt here. Above, other business owners refers to those that own their own separate entities but are also considered part of the ASG. No, that means that if you own, so again, you can have multiple solo 401k plans. So go back and listen to what we were discussing here. Under what circumstance that's allowed? That's allowed if, let's say you own one business where it's just you. That means you can open a solo 401k for that business. Let's say your law firm. Let's say you own a second business that's a real estate operating company, and that business does not do business with your law firm. And what's more, that second business, that real estate operating company, you own less than 50% of that business. Let's say you own 49% of that business, and the other owner is not your spouse or related to you, and that individual owns 51%. That's an instance where you can open up a second solo 401k plan. So now you have a solo 401k plan for your first self-employed business and a second solo 401k plan for your second self-employed business. And we talked about the contribution limits when you have multiple self-employed businesses, as well as multiple self-employed businesses where the second business you own less than 50%. And also that second business does not do business with your first business. So you have to put a wall between those two businesses so it doesn't run afoul with both the control group regulations and the affiliated service group regulations. Let me send over a link that talks about the control group regulations and the affiliated service group regulations. Let me send that over. Okay, I just shared that with you right there. Okay, let's see if we have any other questions here. Looks like we've got a comment here. Let's see. We got a question here from Amy. What happens if I over contribute to my 2025 profit sharing contribution? Can I correct before I file my Form 1040? Does my 2024 5500 need to be amended? It's already been filed. So here we're talking about 2025 contributions. So you don't need to amend your 2024 Form 5500 easy. With regards to the contribution, so the excess contribution regulations can get a little tricky. Number one, separate rules apply as to whether we're talking about an excess employee contribution versus an excess employer, aka a profit sharing contribution. If you make an excess employer profit sharing contribution, and if you made that for tax year 2025, which we're still in tax year 2025, so therefore, you can actually still recharacterize that 2025 profit sharing contribution as a employee contribution if you have enough net self-employment income to justify it. Otherwise, you can still remove it from the plan because we're not past the April 15 deadline, which would be April 15 of 2026. Not April 15 of 2025, not October 15 of 2025. Now, don't confuse the excess contribution rules with the IRA excess contribution rules, which I commonly see individuals do. The IRA excess contribution rules are different than the solo 401k excess contribution rules, specifically in that if you make an excess IRA contribution, you have until October 15 of the following year to remove it. With the solo 401k plan, you have until April 15 of the following year to remove it. So you don't get that extra 6 months. But nonetheless, in your situation here, you made the contribution for tax year 2025, and we're still in tax year 2025, so you can actually go ahead and remove that excess contribution, which is not really an excess contribution because you're removing it prior to that April 15 deadline. You can go ahead and remove that from that plan, and if you don't have any earnings, then you won't have to pay any type of tax on those earnings. Now, let's say that there are earnings in that employer profit sharing contribution. If there are, then you would need to leave that employer profit sharing contribution in the plan, and then you would use it as a contribution for future years. So you would actually use it as a contribution for tax year 2026. So again, the excess contribution regulations can get complicated pretty quickly. So you have to be able to distinguish between excess employee solo 401k contributions versus excess employer profit sharing contributions. And if it's an excess employer profit sharing contribution, then since you made it for tax year 2025 and we're still in tax year 2025, you might be able to reclassify it as an employee contribution to the solo 401k. Okay, if you need more assistance regarding the excess solo 401k contributions, go ahead and submit a support ticket and we can help identify your particular situation further. All right, let's see if we have any other questions here. Oh, looks like Amy is saying that 2024 earned income, it should have been a voluntary after-tax contribution. Well, if you made it as a voluntary after-tax solo 401k contribution, that's considered an employee contribution. And it gets even more complicated because if you've already converted those voluntary after-tax solo 401k funds to a Roth IRA, because keep in mind that make it back to Roth solo 401k strategy, that allows you to make voluntary after-tax solo 401k contributions, and you can choose to convert them to the Roth solo 401k or to the Roth IRA. If you converted those to the Roth IRA instead of the Roth solo 401k plan, now you're going to have to remove that excess contribution from the Roth IRA. So now it becomes a Roth IRA excess contribution because the funds are no longer in the solo 401k plan. Look at that link I just shared. That talks about removing contributions that were converted to a Roth IRA. So if you made a voluntary after-tax solo 401k contribution and converted that to the Roth IRA, you're going to have to remove that excess contribution from the Roth IRA, not the solo 401k, because the funds are no longer in the solo 401k. If they were converted to the Roth solo 401k instead, then yes, they can be removed from the Roth solo 401k, and you have to remove that. Those cannot stay in the plan like profit sharing contributions can. Those will have to be removed from the plan by April 15. And the form 1099-R needs to be issued to report the removal of the bases and the gains. So let me send you a link regarding the excess contribution. So as you can see here, it's very important that you do not over contribute to a solo 401k plan, because it can become a very hairy situation and complicated situation. I mean, it's fair to say it's not as easy as removing an excess IRA contribution. Let me share a link here regarding removing excess contributions. And you're also going to need to work with your CPA and having your CPA issue a Form 1099-R to report the removal of that excess contribution from the solo 401k if it was an employee contribution. But if it was converted to the Roth IRA, you're going to have to work with the Roth IRA custodian and having that removed as an excess Roth IRA contribution. So it gets very tricky. Okay, let's see here if we have any other questions for now. So again, if you have any questions regarding your particular excess contribution question, submit a ticket and we'll go ahead and take a look at it. It's hard to cover that in one session here. So today's topic is how many solo 401k plans can I have? We've covered that topic at great length. So again, go ahead and type over any questions you have. And also, if this information is helpful, please like today's video as it helps get the word out to other solopreneurs like yourself. So One of the advantages of my solo 401k from my solo 401k financial is that it comes with the auto contribution credit, and existing clients and new clients qualify for it. The auto contribution credit is a dollar for dollar tax credit equal to $500 per year for a maximum of $1,500 over 3-year period. You must have a solo 401k plan from a company like my solo 401k financial, who has the auto contribution feature built into the plan along with the related schedules. We started offering the auto contribution credit with our plan back at the beginning of January 1st of 2024. So if you open the plan with my solo 401k financial from January 1st, 2024 and after, we've automatically added this credit to your plan documents. If you're a client of my solo 401k financial prior to January 1st of 2024, we can amend your plan to add an auto contribution credit, and you can start taking advantage of it this year. If you're interested, you would submit a ticket through our support ticket system, and we can add that auto contribution credit. Okay, let's continue with the auto contribution credit here. With the auto contribution credit, it more than covers the cost of having a solo 401k plans. And once it's been added to your plan, you're not required to contribute to the solo 401k plan. You can actually opt out of contributing, and you're still going to be able to contribute in whatever amount you want, up to the overall limit of $70,000. In short, just because it's called the auto contribution credit does not mean you have to contribute to the plan in order to qualify for it. You claim the credit each year by filing Form 8881. It's a 2-page form. We provide a PowerPoint and a video guide on how to fill out that form. You would fill it out each year for 3 consecutive years for a total of $500 each year. So for example, in 2025, you would fill one out, Form 8881, you would qualify for a $500 auto contribution credit. You would complete a second Form 8881 for tax year 2026. You would qualify for the second $500 amount, and a final Form 8881 for tax year 2027 to claim that final $500 amount for a total of $1,500. Okay, so that's it for today, for today's solo 401k session. So, well, looks like we have one question here from Amy. Is the tax deduction taken at the plan level or individual? The auto contribution credit is obtained on the business side. So whether you're a sole proprietorship, S corp, or partnership, you would file that Form 8881 and claim it on the business side. So if you're if your self-employed business is a sole proprietorship, you would claim it on the Schedule C along with Form 8881. It would be filed with it. If it's an S corporation, it would be on the Form 1120S, and along with the Form 8881, it would be filed with that business tax return. If it's a partnership, it would be Form 1065. Okay, looks like we have another question here. Does my solo 401k help a bank account opening of the self-directed solo 401k and all necessary filing required by the IRS? Yes, we help our clients open the bank accounts at their local bank. We'll provide the applicable solo 401k plan documents along with the banking guide. We'll also speak to your local banker to shepherd he or she through that bank account opening process. We do take care of reporting for the plan for those who timely requested. So we'll prepare Form 5500 Easy as well as Form 1099R for clients who timely requested, and we don't charge additional fees for preparing and filing those returns. Let's see what else. Are there withdrawal charges or any additional charges we should be aware of? So with regards to withdrawal charges, we do not charge when you take distributions, nor does the bank or the brokerage firm, unless you have those funds wired. The bank or the brokerage firm will probably charge you a wire fee, but you can also have a check issued. When you take a distribution, you need to make sure you qualify. And again, we would issue a Form 1099R to report that distribution to the government as long as you timely request that Form 1099R. We will not charge any additional fees. So our fees are flat, as stated on our website. Look at our pricing page. and you can see our fees clearly listed there. We're very transparent. I have a Fidelity, but they say their solo 401k does not allow for withdrawals. Well, it's not that the Fidelity solo 401k does not allow for withdrawals. It's the regulations that determine whether or not you can take a distribution. In other words, it's not up to Fidelity, nor is it up to my solo 401k financial. It's up to what's referred to as the statutory IRS regulations. So you have to meet a triggering event in order to distribute funds from a solo 401k plan. We've done a webinar on that topic. So again, visit our YouTube channel where we have over 900 videos, and you can subscribe to that channel and you can access that video for more information on the solo 401k distribution triggers. Okay, again, that's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back here tomorrow with more crucial content to help you secure your retirement.